presentations on the agenda, and I've been informed by Tara that we do not need to approve the minutes because they've already been finalized. So what I would like to do is move on to the discussion items. And what I thought we would do is go through them one by one and let Thierry run us through what is being discussed on each item. And then we will open up for discussion to everyone. And then we'll try and keep moving down the list. And I would like to try and focus more on the last two items because that's really the important business at hand. Not that the first part isn't, but we certainly want to get our investment plan in place and talk about the transition plan because those are the next major steps that we're going to do. So with that, Thierry, can I turn it over to you?
Yes. And
if I could ask everyone to mute themselves, please.
All right, so I guess the first item was kind of catching up and seeing how, just kind of discussing the general economic landscape and the impact of COVID-19. So specifically, I think for the city, I would probably have Craig lead us in terms of kind of what's been the impact on the city of Barrie as a whole. But after that or before that, we can just kind of have a round table and just get everyone's perspective on what has been the impact of COVID-19 so far. So,
right.
And okay, all right, go ahead.
Okay, Craig, go ahead. Why don't you fill us in what's going on, and then we'll go from there.
So I guess the investment board met, I think it was about 2 weeks before COVID hit, or they're in and thereabouts. So since COVID hit in March, initially when it hit, we really didn't have an idea those early days as to what the economic impact was going to be to people's cash flow, who was going to pay their bills and their property taxes. So on a cash flow, those early days were a little bit stressful, as that was before any funding was announced to the CREEV funding or anything like that. So we're trying to balance our own cash flow needs while at the same time council wanting to help the community by deferring payments. So the city took the approach and deferred a lot of the property tax due dates, extended water, wastewater due dates, and that sort of thing. We didn't, fortunately, where we are today is people have been paying their taxes better than ever. Our receivables are close to where they would be in a normal year, which has been a good thing. And so the cash flow overall hasn't really been an issue for us. We didn't have to defer any significant capital infrastructure that was planned. In the early days, we did hold back on some minor capital works. When COVID did hit, the city did take a pretty aggressive approach early on to reduce costs. So, for instance, all the rec centers were closed right away, and there's a lot of revenues that go into the rec centers. So the city did match sort of reducing labor costs in those facilities. There was a lot of folks ended up getting laid off there. We had reductions in services in transit and other service areas as well, sort of in the parks maintenance side of things. So the cost reductions the city did have really helped as we've transitioned. So we see ourselves at the end of September kind of a sort of a budget surplus position. Then on top of that, the province gave what they called safe restart funding, so to municipalities. So the city of Barrie got $6 million for sort of non-transit operational pieces, and then we got another $2.3 million just specific to transit. So we got a total of $9 million, with the criteria that those funds are used for 2020 related COVID expenses or hardships. If the municipality doesn't use up all those funds, and I'll clarify, operating costs, not capital. If the city doesn't use up all those funds in 2020, then you are directed to hold some funds over to deal with any issues in 2021. The province also said if you need more money than that, you are allowed to apply. So we did apply because there was uncertainty around the criteria that how they were going to evaluate a municipality. So, for example, Barrie took a pretty aggressive approach early on to save costs. Some municipalities didn't do that, so we thought we would apply and tell our story to see if there was any rewards for the actions the city did take. So we haven't got a response back on that. When we finish the year end, the end of December, once we go through our year end process, that's when we'll really utilize how we're going to allocate the funds that were given to the city. So for example, the city Simcoe County the city has an agreement with Simcoe County whereby the county provides long-term care home services, paramedic services, and Ontario Works. So the county is experiencing a lot of extra costs in the long-term care side of things. So there is an estimated $600,000 to $1 million additional hit coming to the city related to that for 2020. They haven't finalized their number yet. So we'll apply some of that COVID money to those costs. The city incurred some additional costs in terms of PPE equipment and some things of that nature that we'll apply the COVID money to. And then also we'll probably try and utilize some of the lost revenues with the COVID money. So rec centers, POA, Provincial Offences Act, revenues are way down because the courts have been closed or delayed. So there's a lot of revenues that haven't been coming in on that side. And we'll see where we are kind of once we divvy that all up and how much will be available for next year. So I think overall, our finances are in decent shape, and we haven't, as I say, we haven't deviated from any major capital works at this point in time. There's been a lot of
Craig, would you get a second? Could you go back a little bit? Because I think you froze. Did everybody catch what he was saying, or is it just on my end? Okay.
No, all of us lost him.
Yeah. Okay.
See if I can.
Okay. Give him a ping and see if we can get him connected.
Yeah, I think.
Just as a comment, I had no idea that the city was doing as well as it was doing. I was quite concerned about it. That's a valuable update from my standpoint. I didn't realize that.
Yeah, we've had our staff is amazing. Right, Thierry? There he is. I think he's coming back in.
Okay.
There he is.
Sorry,
Okay.
that was on my end. One of the reasons I worked from home today is because we were having, I had a few problems at City Hall where I've been working out of, and the internet was acting up. So I thought I had a better gig at home. Sorry, what I was saying was, there's been a lot of real estate activity. There's economic activity in the cities is good. We haven't seen a slowdown on that side of thing. Developers are still during the whole COVID experience, even early on, they were allowed to do construction activity. So those plans are still moving. So I think overall, from where we are today, from back in March when this started, when we had no idea, we're reasonably positioned. And then of course, we'll see what happens over the next year. So That's kind of the high level economic position of where we are.
Okay, Terry, did you want to go on with your part of this, or did you want to open up for a roundtable discussion?
Yes, I'll probably open up for a roundtable discussion before I pick it up again and move on to the next point.
Okay, I don't know who wants to lead off, but what I would suggest is we unmute and start a discussion. If you'd like, I'll sort of lead off with my views of what's going on in the economy, and you can go and shoot holes in that all you want. One of the observations that I've seen is, lately is I'm actually discussing this with one of my former colleagues, is that we're starting to see the yield curves start to steepen a bit. I mean, it's not major. We're still, everything's well below 1%, but it is starting to steepen, which is to me a sign that there's a bit of a, I guess, leaning towards a recovery coming of some sort. But one thing that's happening is the central banks, particularly the Federal Reserve, is going to use quantitative easing to try and, sort of tamp down that end a little bit. Bank of Canada isn't pursuing its quantitative easing quite as much. So you might see our rates start to move up a little bit, but traditionally they've been below the US for the last little while. But bottom line, I don't see interest rates going up very much at all. And economic recovery is just going to kind of modestly steepen that curve. In many parts of the economy, both in Canada and the US, the recovery is underway. Sectors having difficulty, obviously, but in my mind, there are two economies here. There's Main Street, and then there's what I call Bay Street, Wall Street, and they're two very, very separate things. Now, Main Street is suffering the most as businesses in the sector are small, medium size, largely service oriented, but the key thing is they've limited access to capital, so necessary for getting them through the pandemic and everything. And this has a lot of implications for local governments, some of the banks, and to a lesser degree the provinces. So, but you look at Bay Street and Wall Street, and with the announcement that they found a couple of vaccines now that seem to be very effective, the logistics of getting them out are tough. But these companies all have access to capital markets. They can all go in and they can tap debt markets, they can tap equity markets. So it's not like they don't have the resources to see them through a lockdown or the resources to retool their businesses to try and fit the reality that the pandemic now presents. So both the markets, the US stock markets, they are ahead of themselves, in my opinion. I think the markets are starting to say, yes, earnings are improving, but they're acting like this vaccine has already been out and is being widely distributed. And we know that's probably not for another 6 months. So in my mind, there's going to be some bumps up and down here in terms of the markets, which will offer investors buying opportunities. But the bottom line is earnings are going to continue to recover through 2021 and 2022. But the markets should view that fairly positively. Just one thing, the US has a lot of wounds to heal, and I expect the America First theme is going to continue, although to a lesser degree. So that to me means our trade is still vulnerable, and US policies going forward may not change that much, if at all, in our country's favor. And then I just threw out a couple of weird black swans, because that's what we're in the middle of right now. And we've had two in the last 2 decades. One is a new mutated form of COVID resistant to the new vaccines. That would just be it. That would do it. The other would be a terrorist incident on a major scale, either foreign or domestically based. Third is a gridlocked US government. And the fourth would be a default of a major financial institution somewhere in the world that causes some ripples to go out. So that's kind of my view of what's going on here. And I'd like to open it up for anyone else who'd like to comment on that or add to that, or shoot some holes in it if you can.
Hey, Jeff, it's Paul here. Hi.
Hi, Paul.
Very good summary. I just pointed a couple additional observations or grow on a couple of comments you made. One of which is obviously we're seeing, increased volatility generally. We're going to see that going forward. As you say, we're maybe a little ahead of ourselves on a vaccine. And if some bad news comes out, then you expect the market to be volatile the other way. But also we're seeing sector decoupling, or some sectors outperforming, some underperforming. We're seeing more of a K-shaped recovery, I like to say, where airlines aren't doing very well, but tech companies have been, and some of those dynamics will probably reverse themselves based on different news, and we're starting to see that a little bit now. So not only volatility in the market as a whole, but between sectors. So we need to be careful where you're putting your money. Rates I think are going to be. But when we met last time, I think we thought rates would be low for a long time. I think they're going to be low for longer than we thought at that point. And we're starting to see, the retail investors really looking to dividend stocks to get some sort of yield, and viewing fixed income less as income and more as capital preservation tool. So that's probably going to continue on for a little while. So that was the only things I had to add from your comments.
Yeah, I agree with all those. Does anyone else want to come in here and comment on it?
Yeah, I can just add on a little bit more as well. I agree with all those points. We're going to see increased volatility going forward. I agree with low rates for a long time, and the market differentiating really between sectors, as you mentioned, and also between individual names. In the past, you could just buy the index and you were fine, but I think that's going to change going forward. The one other thing I would mention is this recent rally we've had. Don't underestimate the Fed and the Bank of Canada providing liquidity, and I think all that liquidity in the markets, what's been driving everything here recently. Really, there's not much alternative, right? You got rates super low everywhere, so everyone piles into stocks or alternatives where so you get pushed more out the risk spectrum is what I'm trying to say there. So, but otherwise, yeah, I agree with the points already made.
Anyone else? Gord? Yeah, I need to unmute yourself, Gord.
All right, sorry.
There you are. Hi.
I would just say a couple things. I think one, for the Canadian market especially, a more belligerent relationship between the U.S., Canada, and China is something to really keep an eye on. And I would say since Biden got elected, that the VIX has come down quite a bit, and so I would be inclined to think, at least for maybe 6 months or something like that, we've got a bit of period of grace here where we won't see quite the same levels of volatility. Now that's excluding any sort of exogenous events that aren't sort of baked in already. But I think longer term, that the markets have gone so far so fast that we shouldn't be counting on very much other than dividend yield as sort of a long-term number to be working from, because the valuations are getting quite extended. Whether it's the sectors that have run or the sectors that aren't doing well. I mean, in both cases, the valuations are pretty stretched. So I think there's, unfortunately, not a lot of all the upside. A lot of it is baked in. As you said, the market already has the pervasive vaccines baked in. I think that's about it that I had for the moment.
Okay, are there any other comments or theory? Does this give you, and Craig, does it give you some idea of where our minds are on this this whole thing?
Yeah, yes, it does. And I think you guys, this is kind of a 360 view of, I guess, reality. And if I might add, it's just, so currently we're seeing the same thing. So adding to what Craig was saying earlier is, again, real estate market, we see anyway, it's been a very strong real estate market. I don't know, we are on track of achieving some best year type of classification. Now, of course, this is also, it's been spurred by everything that we're seeing coming from Bank of Canada and the Fed in the US as well. So low rate environment. Now, with regard to specifics, how these actually translate to kind of what we're doing, we're seeing it now in kind of what the numbers that we're seeing, i.e. the term sheets that the rate sheet that we're seeing. So today, for example, if I look at it based on this environment, again, which is, I'll take a step back. So we kind of, we have it both ways, if I may. So a couple of weeks ago, we issued a 10-year debenture. So 1.3 on 10-year paper, awesome for the city. So we really kind of like that, very low. And a few weeks prior to that, we had a credit rating which was maintained at AA. So again, reinforcing the view of S&P as to kind of what we're saying. Again, fiscally, I don't think we are seeing. We think we are still in good shape. So out 2 years, because that's kind of the outlook that S&P takes. Now, on the flip side, this translates into a low yield environment. So low yield environment, if I look at the kind of major places where we would put money is, kind of money market environment, right? So on the term deposits, your GICs currently to break even to in terms of overnight money, you have to go out like almost 5 years. This is kind of what we're looking at in the GIC space. So 5 years, you, I guess credit union, you like around 1.5. Again, this compared to, pretty, the differential between that and our overnight money is not really, it's not that big, right? So that, which begs the question, why would you lock in for with a GIC for 5 years? Meanwhile, you have overnight money that's pretty much close. So from a break-even perspective, I would say 3 years would be kind of where we stand. Now, if I go into the municipal space in terms of offering, to if we go out all the way on the curve to, let's say, March 2030, the best yield that you can pick up is 1.82. So this is kind of the Canadian municipal paper. And, within the 5 year, which is kind of where we typically look at in terms of investing. So you are still spending, if we go out 2026, you're at about 1.4. Now, if you go to down the yield, the credit, if you go down credit and say, well, you're going to go investment grade, BBB, and corporate. So where you might imagine that you may get some a little of a yield pickup. So you go out to 2030, you're looking at 2.9. You come back 5 years, you're looking at 1.45, and this is for BBB paper. So this is, it just kind of reinforces what everyone's been saying. So definitely a very low yield environment, and as you go out in term, you're not seeing that pickup, and as you go down the credit again, it is not there. So it is very challenging, and it definitely conveys what everyone's been saying. So the environment is really, I guess if you were looking at fixed income and the money market instrument, is really capital preservation, like Paul was saying. And even that, if you're not breaking 2%, so I don't know how much you're preserving based on, if you're on in real term, you can't, you can't break the inflation rate. That's problematic. So yes, that's kind of what I wanted to add in terms of that point. So it is real, and we're seeing it. On one side, we enjoy low borrowing rates, but on the flip side, well, it's a low yield environment.
Okay. Anyone else, or do we want to move on?
Maybe Jeff, I wouldn't mind if, since you all have your crystal balls in front of you, and I sort of touched on, and here you did about the real estate market, but going forward, are, with the environment that we're in, is there, you know, and I'm going to be specific to real estate. Do you see any indicators of maybe slowing paces of growth in real estate, or not?
My personal opinion, seeing what is going on up here, is that I don't think any place outside of the GTA, especially downtown Toronto, really has to worry too much about real estate, because relative values, even with the appreciation we've seen over the past 2-3 years, it still hands down, you know, if you don't have to work in an office in downtown Toronto anymore, why live around Toronto? Why not come up here? So I don't see anything particularly, I guess, bad happening to the local market that would involve the city of Barrie. The one sort of caveat there is the unemployment rate. I mean, that is an issue, but it looks like it's being addressed. But if I was, you know, a major condo developer downtown, I think I'd be a little worried that perhaps the market for my product might not be quite as robust as it once was, given that a lot of people don't want a small box in the sky without any access to fresh air or access to facilities that are in the downtown. That's my opinion. Aurelia going crazy up here too. I mean, just the properties, they go on the market and they snap, they're gone. So.
Yeah, one more thing I'd add to that. I can speak to the condos. Yeah, the rents have come down quite a bit in downtown condo market. Rents are down anywhere from 10 to 20%, depending on the size of the unit. That usually leads price. But prices have come down about 5%, I guess, in condos is what I've been reading. Yeah, that has been real. People moving out of the downtown condos to get yard space, myself included. I moved a couple months ago to have a backyard and some space. One thing I would add is the immigration will be a key factor as well. So we haven't had much immigration in the last year because of COVID, but the Bank of Canada has ramped up their numbers, their targets for the next 3 years to make up for that. So that surge in immigration could recover that market a bit. It's hard to say right now, but in terms of general house prices, yeah, I think they should hold in fairly well in comparison, anyways.
Okay. Does that cover the basis for us?
Just one comment for me from the Barrie and Simcoe County viewpoint. Definitely, anecdotally speaking to real estate agents around here, you know, a high proportion of deals that are getting done are people from the GTA buying properties. So we're seeing them move up. So I think we've seen a bump in prices. I don't know if that pace of growth is going to be sustainable, but I think it'll be supported going forward. We've also had, you know, I took over a bike shop in Aurelia in the spring. We've had people living up here all summer from Toronto, and definitely with the people moving out of the GTA, I think we're going to see, you know, more money injected into the local economy, which will be positive. So I think it's pretty positive outlook for Barrie. You know, notwithstanding we can keep working and, you know, not have more layoffs and more shutdowns and that kind of stuff.
Okay. Theory, can we move on to the second item here on their discussion items to talk about the investment policy update?
Yes, so that's pretty much just a one-liner. So I don't know if we've informed you guys. It was back in June. It was passed by council, and no issues at all. So that was really good. So it was in the midst of all this this COVID and all that, and but he went through, and I don't think it was not held for debate or anything like that. So, which again shows that there's definitely confidence in this body, you know, putting forth policy like this and then having it go through without any hiccups.
Okay. Well, then why don't we start looking at the investment plan that we all received yesterday from Tara. And Terry, thank you very much for putting all this stuff together. A lot of work went into this. I know these can be difficult sometimes to do. So Terry, why don't you go through some of the, I guess, the highlights of what you're looking at here. I think we all understand the capital fund, the growth fund, and the money market fund. And I think we've also discussed the investment objectives as well when we were talking about the some of the investment policy statement items as well. But I would like to talk a little bit more about the risk management side, because I think that's going to be an important part. So Tara, I'm going to turn it over to you. And if you want to do backtrack on some of those items that I kind of skipped through, please do.
No, I think it's good. Generally, it is, as I mentioned, the email is generally the same document that we kind of went through back in March, except for the very last piece, which is kind of the item number 4 to be discussed, kind of the transition plan. And we went back and kind of based on some of the feedback that we had at that meeting. So we kind of reworked the asset allocation table so that you will see some changes. And again, it was just some of the idea, some of the main point was, for example, the benchmark. Again, it costs money to have access to some of those benchmarks. You can just benchmark against something that you don't have access to the data. So again, with COVID, we're trying to be cognizant of not incurring too much fees if we can avoid them. So we try to see as much as possible to, if there's alternative that we already have via Bloomberg or something like that. So have that flexibility. Again, we played with some of the weights as well. But other than that, I think it is generally, you remain the same. So now if you, we can go line by line as we did last time. So if everything is fine, if no one has any reservation, we can start with risk management and see if there are any comments.
Anyone?
We had a couple of questions, and it was a while ago since we had our last meeting. So, but I thought I'd made some notes on some minor changes. But before we go through specifics, the target mix, the asset mix on page 3, I guess, section 4.1, it's changed since our last meeting. Can you go through some of those changes? Like, for example, we've got target mix on federal and federal guarantee at 0 instead of 20%.
Just
previously.
One other thing in that too, I noticed the equity weight doesn't add up in the target. We have 15, 15, and 5, and it has a total of 30. So just wanted to point that out. Maybe we can correct whichever portion is wrong there.
Okay, yeah, okay. Let's see. All right. Okay, so are we going to item 4.1 directly, or is there any comment prior to that to because you had 3, which was the risk management that Jeff wanted to discuss. Maybe we start there and then we work our way down to 4.1.
Okay, well, I have a couple just minor comments then if we're going to go from the beginning.
Okay.
1.12 growth fund. Or I guess actually that should be under portfolio overview 1.2. I guess these are maybe mislabeled, so it'll be 1.21.
Oh yeah, that's right.
1.22, 1.23. So 1.22 under growth fund. I'd made a note in our previous meeting, I think, about just the last sentence: portfolio will manage risk by maintaining appropriate geographic, sector, and corporate diversification. I think we were going to add asset mix before geographic.
Okay, all right.
If I remember correctly. And then money market fund, purpose of the portfolio, just missing the word is to meet. And then in a number of spots, we talk about the money market fund. It says the objective of improving overnight returns I mean, shouldn't that say short-term returns or should it be overnight?
Short term is fine. Yeah, we can change to short term. So, and this, if I may add just a little bit of color to this, as we've been discussing with other cities, with municipal the MFOA as well. So anyway, everyone is kind of in that in that area whereby defining short term based on what they're reading it's just it's all over the map. But the short term definitely would be more suitable. So the reason why I initially had overnight was just because it's really actively managed. So if especially with regard to, let's say, high interest savings account, for instance. So we wouldn't hesitate to move money basically on a day-to-day basis if we see that we can pick up, a few bips here and there. But short-term, generally, I think captures the whole spectrum of things that we want to do.
Okay, thank you. Terry, go ahead.
I think it was Paul.
Or Paul?
Mm-hmm.
Sorry, Paul.
That's okay. That's really all I had until we get to risk management.
Okay. And let's go there.
Okay, on number 2, adequate liquidity. I'd written down our last meeting, and apologies, I can't remember if we agreed to add this or not, but at the end of that sentence says, takes into account of periodic cash flows and reasonably anticipated budgetary requirements. And then I suggested adding, as well as the need to have funds available for unplanned contingencies. So I just throw that out again. I don't recall if we agreed to put that in or not, but I had that written down. Makes sense to me.
That was which item?
3.1 number 2.
Okay, 3.1 number 2. Okay.
Yeah, just the idea that under liquidity, adequate liquidity to have, as well as to have the funds available for unplanned contingencies as well.
Okay. Okay. Was that all? Paul?
That's all I have.
Okay.
Yeah.
Any other comment on item 3, risk management? I think Jeff had.
I think we're fine with that theory. Unless anyone else has any comments, for the rest of the, with the exception of what Paul had in there, I don't see any need to alter any of the wording there.
Okay. All right. So we move on to item number 4. Any question, comments?
Yeah, so just there's some changes there, as we talked about the federal guaranteed going to target mix of 0, and just want to hear the rationale behind that. I don't recall discussing that last meeting.
Well, Paul, you're on 4.1. Is that correct? Policy portfolio?
Yeah, I'm looking at the table.
Okay, thank you. Thank you.
Okay, all right.
I was on the previous page. Okay. All right.
And actually, before you address that, this portfolio policy, is this strictly relating to the growth fund?
No, it is the entire portfolio as a whole. So if you want to think about it, the equity portion would be kind of the growth fund. Okay. The fixed income would be the capital fund, and then the money market would be kind of the cash equivalent. But okay, it deals with the whole.
Okay, thanks.
Mm-hmm.
Okay, so then back to my initial question about the allocation for federal and federal guarantee.
Okay, so that is basically based on the current investment environment. So if we started with the idea, so the previous regime, which was the prescribed list, had basically a minimum that you have to maintain of 30% in federal guarantees, And at the time, it was basically literally zero, earning zero on that and in that space. So as we discussed previously, if you look at it, if we thought it would be better not to have a minimum set, because it be again, in this environment, it's going to be a drag on performance, and but the maximum still being there. With regard to the target policy right now, we just felt like the yield, if we wanted to go right now and put any money into the federal space, then most likely, you're not picking up anything. So we just thought that currently it is probably better to just have it as a range of possibility as things change. If we need to allocate money there, we would, but I just don't see any need right now to put any money in that space.
Yeah, I mean, I agree with the current situation in that assessment, but I'm thinking about if you want to go really defensive, then the most you can put in federal is 60%. Well, I guess it'd be, federal and provincial. And the target mix in normal times may not be zero. 100% agree to have minimum at zero, and that's probably where we should be right now.
Yeah.
But maybe we, I'm not sure it's the right target mix from a long-term perspective. And,
yes.
And also your maximum, I think, could be higher than 60 if you want to be able to go very defensive.
Yes, and actually we're thinking about basically even collapsing the two lines, so the federal and the provincial, and then just kind of going to just having those two together. So that's kind of what where we kind of got to that level, circle one, just make it kind of government, including your provinces as well. But I guess for the sake of being able to track them separately and benchmark, then it wouldn't really make sense.
Yeah, and also I think there's liquidity implications too. When you're talking about federal versus provincial, and especially versus municipal.
Mm-hmm.
So
Yeah.
I don't know. Yeah, I'd probably want to have some delineation there personally.
Mm-hmm.
But I'm curious what the rest of the group thinks.
Anyone else?
Yeah, I think it's good to keep them separate. Most of the policies I've ever seen, they have them separate. And to your point on the liquidity, yeah, when you get into a liquidity crunch situation, you do see a real lack of liquidity, and especially in munis. Provincials usually retain the liquidity in a couple of the bigger provinces like Ontario or Quebec, maybe BC, but the other provinces, liquidity dries up pretty quick too. So we saw that in March, for example, where all the secondary provincial names, the liquidity dried up fairly quick.
Okay.
So it's really dependent on how much liquidity we need.
Gord, go ahead.
Yeah, just a question. If for example, we get in a year's time or a year and a half time, a more robust economy and rates are tightening, in that scenario where it's a good economy but rates are going up, what would your expectation be of the performance, federal versus provincial versus corporates?
Yeah, if rates were going up, typically you'd have more protection in provincials because you have that credit spread component as well, and then even more so in corporates because you have that larger credit spread component. So, so those sectors with the credit spread are definitely more defensive in a rising rate environment. So
the spreads versus federals would compress in that case then?
Typically, yeah.
Oh, okay.
Yeah.
It's been a long time since we've had a rising rate environment.
Yeah, exactly. Or even if they widen marginally, you'd still be better off. You can run the break even between holding the government or holding the credit piece, but just that extra yield protects you from a bit of that rate increase.
So what are suggested changes for that target mix? Can you summarize that?
Actually, just a point of clarification on the target mix. Is that target mix today? Because maybe that's correct at zero if it's for today, or is it a long-term general target mix?
So,
And is this target mix going to change every quarter when we meet?
I would say, I mean, generally it's supposed to be kind of a long-term target, right? So, but I think the investment plan has to be kind of revisited every year. And I would say on that basis, this is probably would be kind of, at least out now till, the next time when we look at this.
Just one point on the target mix. I've always treated that as your standard for how you are measured, rather than sort of what you should be targeting. Secondly, because you're measuring against that, you can't change it frequently. If you change your target, you've got a broad enough range between the minimum and the maximum that you can play anywhere you want in those different areas. And the outcome, whatever it might be, is, okay, well, how did you do relative to the target mix that we set up? And what I would suggest is that we come to an agreement on this target mix, and then we hold on to that and we just see how we're doing. We can always alter this. It's not cast in stone. It's difficult to change because we have to go through all the hoops to do that. But I think we need to come down to something here that makes sense in the current environment and going forward the next few years. And if we don't think it's working, then why don't we alter it? There are probably things in this document that we haven't thought of yet that we will have to alter at some point. So it is kind of a living thing. It does change. Anyone else's comments on that?
Yeah, I'm just trying to work through the administration side of it to your point, Jeff. So, and Thierry, did council help my memory here? When we went to council to approve this, were they approving the current asset mix? Like, we've changed this, but they just, or were they approving a statement?
Yes. So the investment policy did not, because again, did not address this. It recognized the delegated authority of the board to actually provide this document.
So if I understand what you're saying, Jeff, you're saying we should have some mix that's really reflective, not just of today, but of a little bit longer view.
Yeah.
Yeah.
Because you can't keep changing your goalposts.
Right.
That's the thing. If
Right.
you're going to do effective assessment of how the fund is being managed and how well you're doing, it's got to be a somewhat of a constant thing. But as I say, it's not forever and ever. I mean, if it is inappropriate or the city's needs change and we have to sort of reorient the portfolio, it would be unfair to say, oh, well, we're going to hold you to this old standard, even though we don't want you to be quite so aggressive anymore. And of course, you'll always lose against that in the long term. That makes sense.
Yeah.
So
sorry.
I was saying, so we should have then for our meetings another column that, current mix, and that has to be defended against the target mix in terms of why you're over or underweight certain sectors.
That's part of the assessment process that we're going to be doing every quarter, I would think.
Right.
Because we have to review this every quarter, and at the end of a year, we have to present a report to the council about how we've done.
Right. So this is the static piece and the flexibilities on defending it each period.
Yeah.
Is the lens then is it a 5-year, a 3-year, and we sort of separate out the COVID for now for this exercise? Or is it a mix? I guess.
I think we're supposed to review this every year. So, once we approve this, again, in a year's time, we have to come back to this document and say, and of course, the investment policy statement, and say, is it still relevant to the situation we're dealing with? And I'm not saying that we should be changing it all the time, but what I'm saying is that you must constantly be reviewing it to make sure that it is suiting the needs of the city. And it's not something that's just sort of we're going off in this direction and it's not accomplishing what we want it to accomplish.
So again, from the just kind of looking at the deferral, like one of maybe the reason why you may entertain that would kind of putting money there is like in terms of securities lending, right? So, but we've tried. I mean, it is there is being offered by the custodian as an opportunity, but just being able to get into that space whereby someone actually borrows those securities, so you get a little bit yield on that. It's a matter of size. You have to really have a big amount, and the system as well. I don't know. So I think Milan is saying that I don't know if it's kind of a lottery system in terms of kind of which account gets pulled. So it's a little bit of a lottery, but that would be one justification in terms of allocating money there, even though that the yields are so low, with the potential that you may get a little of you may get something back in terms of it being lent out.
But that would be minor to the overall what you're doing, and if
Yes.
I can just summarize that. If I could just steer this a little bit, I think we should decide on this target mix because it's going to be very important yardstick for us in terms of assessing how our fund is doing. And we need to correct that math error that Paul pointed out in the equity side, but also resolve sort of whether we want to have federal bonds in there as part of the target mix or whether we leave it out.
Yeah, I thought we agreed on this back in our last meeting. I'm looking at the document. It says effective date, review date May 11th, or effective date May 11th, where we sort of agreed to take emerging markets out of the equation,
Yep.
which is reflected here. I guess we largely agreed on the target mix at that time, I think. Maybe someone could refresh my memory, but I don't know if anyone has that table in front of them still, as well.
I don't.
Yeah, I think.
Jason, Terry, do you guys have the original one? We looked at?
I'm gonna try to pull it up.
I'd have to go into another window in my computer, and I don't want to do that.
Yeah, I've my it's I've got it here. So the original one said was 20 20 federal, 30 provincial, 20 corporate. And it on the equities it was 5 Canadian, 15 US, 5 EFI.
Right. And I'm on the range on the federal was 10 to 100. We can discuss if we want to bring that minimum down to 0. But that target mix I think seems reasonable for a long term, and the current mix that we have in the new document maybe is appropriate for our immediate target or what we think it should be, given the current environment.
Right.
Okay, so we need some direction here.
Well, I mean, I think what Paul said is exactly right in that I think these ones from the previous meeting make more sense as the target mix, as you were describing it, as a longer term thing that is essentially the goalpost, as you say. And then the one in the current document is our current allocation within that mix.
Yeah.
Should we have 2 columns, one with long-term target mix and one with current target mix, or something like that? Or
Yeah, we certainly should.
I'm not sure if the current target mix goes in the investment plan though, or
right.
that's,
No, it wouldn't be in the plan. It would just be separate, like
for our discussions and tweak that and argue one way or the
That's
other.
more strategic. That's
Yeah.
more of a strategic
So
move than it is.
one
a
is tactical and
So are we agreed that we should be going back to what we had talked about back earlier in the year?
I agree.
And Theory, how are you with that?
I'm fine with it. I mean, that was the so anyway, my recollection, I know we had discussed this document back then, but I wasn't sure if we kind of settled onto what those target would be. Hence the kind of the revision. But otherwise, I have no issue. Again, we recognize that the strategic has to really be long term, which is kind of the long term. But again, we have to be agile as well, so that we recognize the current situation, or the near to medium term. So
Okay.
yes, I have no issue with that.
Yeah, I think the more important thing for you, Theory, and your group is the minimums and maximums, because that's your maneuvering room. I'd like to, if we agree that we'll put the target mix back where it was, does anyone have issues with the minimums and the maximums that are in place in this document?
Yeah, I mean, from my point of view, for federal, you want to have 100 as your maximum, because if you want to go and you want to be uber safe at some point, you want to be able to move all your money there if you need to. You're probably never going to do that, but it just gives you the flexibility to do that. So I'm always in favor of having your maximum at 100% for federal.
So the 100%, I think the reason why we did not default to 100, because if you take into account the money market, which is the cash equivalent. So
right.
Then if you want to always have liquidity there, then
yeah. So your federal bond and your cash should add to 100 combined.
That's correct. Yeah. So
You'd want 85 then, is that correct?
yes, just putting up the
Or 70?
trying to bring up the old document here.
And I'm just thinking for the fixed income target mix, should we use, if that's just kind of our long-term mix, should we use kind of what the bond index weights are for the three components?
Mm.
Not to say that's where our management target would be, in this environment, you'd overweight corporates, overweight provincials, but use the benchmark as the long-term.
Use the universe bond index as your
target weights, yeah.
Target weight.
Obviously you can move off them strategically for sure, but yeah.
Yeah.
It's a lot cleaner for measurement too, because you're only pulling up one number rather than two, trying to blend it. So, and that's been the standard in the industry for many, many years as well. If I recall straight. So.
Yeah, that makes sense. So now that which kind of touched on the benchmark issue. So far again, I mean, you can get access to the data after the facts, but we currently we don't have. I guess
data. Okay.
We don't have data. But since the whoever has the person who has the purse is in the meeting, so. that is we work through that. So I hope is that we'll be able to sign up for some of those benchmark, but otherwise we'll probably propose some type of. Bloomberg has been I think they're partners with the Barclays, so they really started to revamp a lot of their benchmark. So, but the problem with Canada is that there's no depth. So they're good with international bonds, US and all that, but Canada is still very light. So de facto, you have to go to the FTSE TMX bond universe. But
the Bloomberg, actually, we took a look at it. A lot of other managers have too, but no one's really moved over to it yet. Everyone's still using the FTSE.
Yes.
I believe the FTSE, you can get the daily summary on their website at the end of each day for free. It'll just give you the general corporate weight, the general.
Exactly. Yeah. I think is it next day? Anyway, but within a few days you get the daily.
Yeah, it's sometime that evening. It could be in the middle of the night or something. I'm not sure what time exactly, but.
Okay, so we're gonna go to the universal weighting then, Thierry?
Yes, we can do that. That makes sense. We
Okay.
can use that as the strategic weights, and then as long as we have the leeway of being able to move between the minimum and the maximum, we should be fine.
Okay. And then you would take out the sovereign bond index and the investment grade corporate bond index item, and just use the universe bond index as your yardstick to measure against.
That's correct. Yes.
Everybody agreed with that? Good with that?
Yes.
Yeah.
Okay, good. All right.
Just also missing from this table from the last time, we had real estate and infrastructure on the table at 0 target mix, but we had included them. Those no longer appear. Is there a reason for that?
I think that was kind of again recalling some of the discussions. I think I don't know who brought up the anyway we
Yeah, it was. I think it was me, Terry.
yes, okay, all right. I kind of had a sense that there was really no, okay. All right, go ahead.
Yeah, I mean the point is that we as a group, and Terry and Jason, we have no pipeline, we have no contacts, we have no advantage at all doing infrastructure or anything like that, and it's there's not the liquidity there that you get with the public markets.
Okay, so we define real assets later in this document, so maybe we can take that out then.
Yeah, I was just going to point that out, that we in 6.1.3 it's covered there as well. So, but as far as our policy mix, I think we just use the table here with the alterations going back to what we had talked about earlier in the year.
Like, I think the minimums and maximums we had before sort of make more sense than what's here in this table. So,
well, at least for fixed income.
Yeah.
I like the current ones. I like the new ones better for equity.
Yeah, I think I agree there. Yeah.
Okay.
I mean, we had minimum 10, maximum 100 for both federal and provincial, but I guess if it's minimum 10 in each, you'd have to have a maximum of 90. You can't have 100, but
yeah, I imagine there are times when you're going to be wanting to sort of use different levels of credit quality to enhance the portfolio. So being able to be at 0 in Government of Canada bonds, if you don't think if you think you can get better leverage out of the other sectors, it's probably makes sense. To your point, if you have minimum 10, then you are going to have limits on the upper side.
So yeah.
All right. Can we move on now?
Can we just address what our target mix is for the equities so that it at least adds up?
Yeah, are we going back to what we had last time in the meeting?
Well, that needed to be adjusted because we removed the emerging markets.
Yeah.
Okay.
So I would say, is it then, should Canada maybe be 10? Because it was previously Canada 5, US 15, 5 EFI, 5 emerging markets. So
right.
Could we, like, would it be 10 Canadian, 15 US, 5 EFI?
Yeah.
Yeah.
I think that's what we modeled. Yes.
Okay.
Mm-hmm.
I think that makes sense, Gord. And we do have the flexibility to go far beyond that if we want to, especially if we're dipping our toes into the market. We'll probably take baby steps in Canada first before we take the big plunge into the US. So,
Cool.
But who knows?
And just on that point, I've been really, I see Craig is smiling. I've been really kind of pushing the idea. I'm like, yes, this is his target mix, and then he might take us some time to get there, right? So there's no risk of getting up tomorrow morning and buying whatever X amount of equity. So it's going to be a gradual process. We really gonna probably walk our way through the economic cycle. That it is going to be really gradual. So.
And on the foreign equities, we're going to keep the currency risk, right?
Yeah, that's correct. Yes. Yeah.
Diversify.
Yeah. Craig wanted to add something?
It's fine. Just the international equity excluding Canada and the US. That one's clear. That's not emerging markets. Long that's gone.
Markets, no. All right, can we move on to portfolio rebalancing?
Yes.
I'm having a couple of things jump out at me here with portfolios will be rebalanced is the second sentence, to as close to the target portfolio as reasonably possible when asset class exceeds the minimum or maximum defined ranges. Terry, can you explain sort of what?
So basically, the idea is that let's say we decide to have exposure via ETF, sector ETFs. So you have a tech ETF that all of a sudden SpaceX gets added. Overnight, it just blows up, and then you find yourself with twice the amount. So you have a substantial gain. So then, what is the time frame for you to bring it back to rebalance? So is it something? Is it or on the downside? Is it what's that time frame whereby because here we have the minimum and the maximum, but we did not kind of specify kind of your range, right? How if I take the Canadian equity for example, we said 10. So is it if I'm at 11, am I still fine, or is it 13 and then you have to bring it back to 10? So that's kind of the idea. So is that same with the fixed income? So what is are we setting kind of hard channel saying that, okay, well, if I trigger this, then I'm going to have to rebalance? So are we saying within reason, we'll take the time to basically bring it back? That was the idea of that sentence.
Could I just ask you a question? So when you say the target portfolio, is that the same as the target mix, or is that the target portfolio that you strategically are doing at this point in time, given the market conditions?
Now, based on what we just defined, then since we just said, okay, well, there's going to be the actual target mix and then the kind of current situation. So, but I would take it back to, this was written with just one being the target mix, right? So that was just, in case you, based on market things that are out of your control, if you deviate, then and you have to basically bring it back to side, or same as I think there's a last sentence there. Let's say if you look at fixed income, if you have a downgrade in your portfolio, for instance, right? So how long does it take you to kind of bring it back, right? So that these were kind of the that's the reason for that sentence. Saying, well, give ourselves time and then we do it within reason. Now, can we put in a hard target within a month, within 6 months? We can, but we just thought that reason was a reasonable time to kind of
Any other comments, or anybody have issue with this? Am I barking up the wrong tree?
Well,
No.
should it be? Sorry, I was just gonna say, should it be reworded to reflect? Because I think it's written to reflect the portfolio table above, but it sounds like we're going to deviate from that table certain periods in time. So maybe it needs to the language needs to reflect that flexibility piece. So that's the long-term benchmark we're measuring ourselves against, is what I think this is written, what it's describing, right, Thierry?
Right.
Yes, that's correct. Yes.
And then I don't think you want to be forced to go back to that.
Right.
When you already have a strategic mix that you're doing in mind, like that, counterproductive to what your management talent or investment management talent is adding to it's just if it's an automatic thing.
That's correct. And again, as long as it's justifiable, if we maintain it, we'll have reason why as to why it's that way. So,
but this also seems to address the extremes that says when you exceed the minimum or maximum defined range. So if somehow you find yourself in international equities with greater than 15%, this seems to be saying you got to get it back within the range or towards the target mix as quickly as you can. So it's sort of two different things. Like it says minimum or maximum, and that's a little different than being a couple % off your target mix.
Yeah.
Yeah, I think it would be nice to, I don't know if it needs to be in this document, but just a little more detail on the process of rebalancing, whether you do it like it says you'll do it quarterly, but will there be, percentage deviations beyond your current targets, not your target mix, but your current sort of tactical targets in the interim, or will you just rebalance on a quarterly basis? I would suggest not at the end of the quarter, but just a little. Maybe Terry, you can tell us a little more how you envision the process of the rebalancing.
So the process of rebalancing, I think definitely the quarterly, just having kind of that quarterly time frame first just makes sense for the sake of discipline. Now, the second thing that based on this specifics is that you have chances, especially when you have large inflows of cash coming in, or if we have like a capital call, right? So you have those moments that would basically force you to kind of revisit where you're standing. So we want to basically avail ourselves that opportunity, right? So it is what we're working with is kind of best as much as we know. This is kind of the best estimate that we can have of the future. But we do understand that there are things that happen that are beyond our control. So all of a sudden you may have a development pickup, and then in December you get 100 mil in development charges. So then again, that gives you a chance of saying, oh, well, even if it's not within the time frame that you set, it is an opportunity for you to kind of rebalance. So if again on the flip side something happened and then you have to pull money, then again that is a trigger point. So the quarterly was okay, but that's the discipline of doing it. But again, you have to recognize that you have those additional points of rebalancing the portfolio should anything happen.
And I'm sure you've told me and us before, but how frequently do you expect, or do these cash flows happen? Are they weekly or like sizable enough that would provoke a rebalance?
It is. So I would advance some idea, but I'll have Craig add to that as well. So far, all our projections we've been very, very conservative. So conservative on our revenue forecast, and literally we come close to flatlining our revenues growth, close, not exactly. And then on the expense side, we were very conservative as well. And then the other thing that we do is like, because we have the additional benefit of being able to determine the timing of debt issuance, which is an inflow into the city. So when we forecast the cash flow, we get to those points whereby you say, well, here's the authority to basically bring in X amount of additional funding into the city, but what is the timing, right? So we not only look at the actual economic environment in terms of, okay, well, is this a good time based on rates, but also doing the cash flow forecast, then you would see those inflection points whereby you say, okay, well, that is an opportunity for me not to disturb what I already have as investment in terms of bringing money back, but to kind of issue debt to beef up my my cash position. So the money market portfolio is really where you're going to see a lot of fluctuation, right? This is why we say, okay, well, if there is any excess, we'll push it into the money market portfolio, right? So, and that's really where you're going to see a lot of swings. Okay. Greg?
Yeah, just on that, Jerry. So I guess it really relates to the funds, right? Like we got capital, we got growth, we've got money market. So to your point, the money market is more or less where you're parking our working capital, right?
Yes.
So one of the challenges for Barrie, as we grow, we're expensing a lot. We're putting a lot of infrastructure. So, you know, are we, Thierry, landing on the size of portfolio for capital growth and money market? Because you know, the growth, the capital fund, the longer term fund you're mentioning, you know, you're probably not going to see a ton of there'll be a bit of an increase, but I would say in the early days there won't be a ton of extra money coming in available in there. I think you'll see a lot as, you know, you will have more in your short-term portfolio than your long-term portfolio. So, I wouldn't anticipate a ton of rebalancing going on as long as we delineate between those three areas,
Right.
almost quantify the amount that we're investing.
Yes. So, and to just, because I don't know if you recall, if you look at the initial document, I think we had talked about the kind of the money market portfolio, but it was not there. But now to kind of simplify and really kind of make things cleaner, because you already get asked that question. So as per the act, is like, okay, how much money is it that we are pushing to the board, and how much money that we are keeping? So this format literally makes things cleaner and simpler, right? So we know that, as Craig mentioned, the money market portfolio is really kind of where you'd see a lot of the working capital being in. But the first thing that we stick in terms of our forecasting, we de facto leave about like 10 million in the operating account, which is where you see the actual transaction. Now I'm talking specific, right? So 10 million as kind of the buffer, and then that should, we try to maintain that as much as possible. So then in terms of added layer, we have the line of credit, which is to the tune of 25 million should anything happen, right? So, but we take 10 million, we say this is kind of the balance we want to keep in the operating account. Now, any excess goes into the money market portfolio. So now the two other portfolio, the way they ladder up. So the fixed income portfolio that we're talking about, which is really kind of a cash flow match. So that's where we kind of look at it and say, okay, well, on the long term, if we look at it, can we invest those funds so that they would generate added alpha, and then as they mature, they mature into the money market portfolio, and then they get back to the city. So the growth portfolio, or the long-term portfolio, which is mainly the equity portfolio, is really where we say, okay, well, we can literally have that amount of money staying in that fund for the long term, so that we are really seeing a good pickup in growth, right? So we're not expecting that much. So if it's a dividend, for example, and then you get dividend income, if it does not move you beyond your boundaries, you can see that flowing through the money market portfolio and then being available to the city, right? So that's kind of how the waterfall looks like. So day-to-day working capital is kind of the cash and cash equivalent, the money market portfolio. The longer term, whereby we have that opportunity to kind of look at, okay, well, 1 year, 2 year, 3 year, 4 years, that is the fixed income portfolio, right? So then that anything that matures, coupons, comes back to the money market portfolio, and then goes to the city if there's a capital call. So that's kind of how, as you look at the table again, if you imagine the equity as kind of the capital fund, and again we call it capital fund so that it is kind of a long-term in nature, and we're hoping that it'll be able to provide enough return as to face kind of the asset challenges that we have, like the funding challenges. So the fixed income is really the 0 to 5 year cash flow forecast, and then the working capital is in the money market. Make sense?
Mm-hmm.
Okay. Again, some of the taxonomy again was that it is simple, and then it kind of lines up with CD lingo and all that, and then some you can look at it and see how it flows, but day in and day out, where you really see a lot of transaction is really in the money market portfolio.
Okay, could I suggest that second sentence in 5? I've written something out here. I would just feel more comfortable with it and
Okay.
look for some comments. Portfolios will be rebalanced to correct the asset mix when any one asset class exceeds the minimum or maximum defined ranges. So you're just dealing with the ranges rather than the target.
Okay.
Does that make sense? And
Yeah,
then
I agree that it's two separate things in that sentence right now, and let's address the ranges.
yeah, you want to address the ranges, not so much the target.
Okay.
Yeah. Yeah, the min and max makes sense for sure.
Yeah, because there you're out, you're out way out, you're way outside the campus there. You're not, you're not
Yeah.
where you should be.
Okay. Could you repeat that sentence?
Yep.
Yes.
The portfolio will be rebalanced to
Mhm.
correct the asset mix when any one asset class exceeds the minimum or maximum defined ranges.
Okay.
I got it recorded, Terry.
All right, perfect. So I was just going to ask you if you getting all the changes, because I'm taking as much as.
I have them covered.
All right, perfect.
Thank you.
Okay, thanks, Jason.
And I don't have any issues with the rest of that paragraph. If anyone else does, please.
And if I could take us back to 4.1, I know that Jeff, you had mentioned, because we said in terms of the fixed income. So there's in the note number 2, it says investment grade, but we did not call out what kind of the what that rating is. I don't know if there's any value of. Yes, go ahead.
Could I suggest that we address that in 6.1.2?
Okay.
It's probably better done there. You've already stated a minimum investment grade by a major credit rating agency, and then we can address that as a separate item specific to the asset class.
Okay, perfect.
Okay. All right.
Sorry, can I just clarify one thing? Well, on 4.1, because in my notes before from May, I had, or the last document I'm looking at, I'd written growth fund only, and then we just talked about capital fund, growth fund, money market fund as being the aggregate of those three funds being covered by this portfolio policy portfolio. But that would suggest that if you, for example, had $100 million, that 30 million of it is in your growth fund and 55 million is in your capital fund and 15 million is in your money market fund. Like, do those numbers add up?
Yes, that's correct. Yes.
Okay.
No, so you okay? All right. I get
Like
it
just feels like we might have a portfolio mix for the growth fund, a portfolio mix for the capital fund, and whatever for the money market. Money market fund less important, but I don't know how this could capture all three of those in aggregate and coincidentally be the right mixes between equity and fixed income.
Sorry, I'm not sure I
So
follow.
earlier, if I understood correctly,
Mhm.
someone said the equity is kind of the growth fund,
Yeah.
and the fixed income is the capital fund.
Mhm.
So is 30% of your money in the growth fund right now and 55% in the capital fund?
No, we haven't allocated anything. So that's the idea. That's the idea is to basically say that in the growth fund we'll have basically equities, and then it'll be 30% of your overall portfolio.
Okay. So
Yeah.
so you don't currently have a fund called the growth fund with some amount of money in it.
No, you
put that. Okay.
No, it was created by way of the IPS being approved, so that we can basically call it that way, and then kind of segregate in terms of.
Okay, that clarifies for me. Thanks.
Now, Theory, when we do measure the portfolio, given that it's got an equity component in the target mix that we're measuring against, and there's going to be a transition for you to get there. I don't know if it's, half a year, 1 year, 2 years, however long. And bond markets continue to sort of do what they do, which is basically return nothing, and equity markets return more. That's going to put you at a measurement disadvantage, which I think we have to recognize. So I just wanted to point that out to the group, that it's, as we ramp this thing up, and eventually we will get there, but we're going to have to put a little star beside the performance and say we're still rolling out the equity portion of this as we build the parts of the portfolio. Just something to consider when we're measuring every quarter, because it could be disappointing, or well, it could be great if the equity markets crater and the bond markets go up. You can still get it the other way, but I would say longer term, that mix is going to be somewhat aggressive, and you're going to want to have that growth portion being fairly full, at least close to where the target mix is.
It's a good point, Jeff. I think we almost have to introduce the idea, like in the municipal sector, right? And how are we doing relative to returns in other municipalities, or the one fund is really, when we've talked to council, that would be our benchmark. So while are we outliers on similar type portfolios in other municipal? Most likely we won't be, because they'll be sort of a similar. But I think that somewhere we need to incorporate that in, because you're right.
So I think that would come in as kind of a general comment, kind of a peer group comparison. But in terms of specifics, again, this kind of comes up, and it is different IPS, different reality, and to get it clean, this would be definitely a way to evaluate based on the mandate, right? So now a city that has a different mandate or a different take on things would have a different IPS, i.e. different type of boards, but which does not preclude us to say, okay, well, let's compare ourselves to peer groups. If we see that we are underperforming against the peer group, then we ought to look at what it is that they're doing that we're not doing. What do they see that we don't see? And then we can come back and say, okay, well, let's make those adjustments. But the more we're able to currently focus on the city of Barrie as kind of the reality, right? And then say that, okay, well, we are doing it this way because of the reality of the city of Barrie. So realities being that we're constrained by a lot of things, right? So we don't have we're not flooded up with cash like a city that's fully grown, right? So we use all this, and then we tailor our solution to what the city of Barrie, the needs of the city of Barrie, in a way that is conservative. So the more we can stick to that message and convey that, I think it'll be less disruptive. Somebody comes and says, oh, well, city of Toronto or city of Vaughan did this. Yes, that is true, but you got to recognize that if you want to get that, we may have to be more less conservative than what we are, right? Which again breaks the whole chain.
So Theory, are you comfortable with that target mix given the realities you face?
I guess you nailed it. That's where we started again with the investment environment, right? So and as we look at this, the only solace again is like no one has a crystal ball to see what the future looks like, right? So I think we're starting this again. It's work in progress. We're going slow and steady, and again, who knows what the macroeconomic landscape will look like a year or two from now. But if there's any one thing that we ought to recognize again is that if you generally try to time the market or pick a bottom to invest, or top to diverse, it's really never a good a good strategy, right? So if we look at currently, for example, our current portfolio, which is kind of the remnant of the ones that we have, is year to date we are 2.7. So again, is it something that we did right now to kind of get there? No, it's just because at the time when we deployed it, was given what we had, what opportunities were there. But applying ourselves to just do it in a way that's methodical makes sense. And now, you kind of see the performance. So if I say right now I have a 2.7 yielding portfolio, who would like to buy? Well, many of those cities will line up today. But when did we get it? we got it, a few years back, right? So it's one of those things that I think just by principle saying, we make decisions based on the best information that we have at the time, and then we assess, right? It's never that's at least that's kind of how I view it.
So to be measured against a 30% equity weighting going forward, you're okay with that?
Yes, but I think in the document we also kind of said that the performance will be kind of on a 4-year rolling basis, right? So yeah, it's not a point in time, but it's an average. But again, as we go through this, the asterisk has to come in. So whereby we recognizing that this is still kind of we're moving towards the target mix. Now, is it going to be in January? Is it going to be in 2022? We don't know, but we're going to work our way there in a manner that's very prudent to get there. So. Well, you guys are going to be also the first to kind of gauge. So I guess you guys are already aware, but yeah.
Okay.
Yeah, I mean, you just state that we're in a transition phase for the first year or whatever it is.
Yeah.
There, right? So
transition year.
I think everyone will understand that for sure.
Yeah. Okay.
Does the equity does the mix reflect the risk profile?
Are you asking me or Theory or
the general comment? When you, from your own perspectives, and your understanding of the municipal sector, is that do you think they match? Is that equity weighing too high?
Well, being a guy that loves equities, I don't think any equity weighting is too high. But the municipality, I would put it on the slightly more aggressive side of exposure. But I mean, the reality is that if you're looking for growth, you're not going to get it from bonds. It's not going to happen. You're going to be stuck in the same rut. So I think you have to go out that risk scale to be able to do what the city wants this fund to be able to do.
So preservation. Sorry, I was just going to say preservation of capital is a big goal as well, right?
Yeah.
So
what would we say the time horizon would be on that growth fund?
So it is if we go back to the first meeting, was basically okay. Well, the money market fund is kind of the very near 1 year, 2 years. So the fixed income is kind of 5 years outlook. Yeah. So and then the long term, kind of the 5 to 10 year, or the long term is the growth fund. So the idea is that what the growth fund would be really again, if you go back historically and then you take market return, like what is the break even or where you get your money back, even if you invested in the worst period, it's like 5-6 years. That's the so I guess the learning there is like if you pick any point in history, I guess the last 100 year, and then you find the worst day to invest. If you held that investment 5-6 year, you would have recovered and lost in the interim. So
right.
That's
largely covering inflation these days, right? So
exactly. So and back to Craig's comment, capital preservation. If we go back to that, currently we kind of left it without specifying. But if you really want to say capital preservation, then you are embedded 2% at least inflation rate. And in this environment, basically, we're not preserving any capital if we were to go fully fixed income. So we're eroding. So if you were to to really, as if I was to come in as a taxpayer and then you show me this, I would say, okay, well, you know what, return me my tax money, let me invest it, and then when you need it, let me know and send it to you. Because if you're gonna keep my tax dollars and then have a sub-inflation return, I would say, okay, well, fine, just let me know when you need it, I'll give it back. But in the meantime, I'll take possession and get you know, perform better. So
I guess from my perspective, Thierry, I think, and curious of the others' perspective on it, and Jeffrey's comment of, you know, maybe it's aggressive relative to, or maybe the percentage, and I don't want to put words in Jeffrey's mouth, but if it's a little risk, if it's a higher risk portfolio mix, I'd probably be a little more comfortable if we were to lower to match kind of our risk profile. What that number is, I'm not really sure, but
Now remember, this is the target that you're being
Right.
measured against. It's not
Right.
what you have to go towards.
right.
And my whole point in this is that I don't want to put Theory and the investment group at a disadvantage with this bar that's way too high for them to jump over.
Right. So, it's the
So I mean, he
transition
doesn't
get
have to
there.
do anything in equities if he doesn't want to, because he's got zeros all the way down the line. So, but when you do have a target and you're supposedly being measured against that, most managers will go, well, geez, what have I got to lose? I might as well go in there and, you know, at least be in line with the benchmark so that, you know, I can't get criticized for it. And I've seen managers do that all the time. I mean, that happened to some of the portfolios that I was overseeing when I was at OMERS, that they would just, you know, all of a sudden, oh, let's just go to the benchmark. We've done what we need to do for the year, which isn't really investing money. It's just kind of your indexing to a degree. So, but we could lower that. I hate to go back to 4.1 and redo the table, but we have to be comfortable with that, because if we do approve this, then that's what we're dealing with.
Just a point of comparison, I think pretty sure City of Toronto, for their long-term fund and their sinking fund long-term asset mix, so they have two different tables. They used a 0 to 30 max with a target asset mix of 20. So not that we have to do the same as them, but just throwing that out there as an example.
Good information.
Or that was equity?
Yes, that was equity. Total equity.
Yeah.
Just another reference point too, like I'm at a P&C insurance company right now, and most P&C companies use 20% as well for equities.
Oh, I didn't know that. Okay. PNC, yeah.
But did we say the time horizon is like 10 years? Is that
Over 5.
5 to 10 years, yeah.
Yeah. Measurement time periods are typically 4-year rolling.
No, I'm saying like for
Assessing
the
an
growth
asset.
part of the portfolio. If the growth part of the portfolio was 10 years, I guess I'd be pretty comfortable with 30%
Yeah.
target. But if it's 5, that does seem, you know, maybe on the high side.
Yeah.
Yeah, I you know, in the municipal world, there's an election every 4 years. That's
Incidents, yeah.
long term.
Well, shall we lower that target?
I would be more personally, I would be more comfortable if we lowered it. It'd be hard to justify, especially if others are around 20 in the municipal world and we're at 30. I'd have a hard time relative to a risk profile explaining that. So I think 20 would be reasonable. But open to your opinions, please.
So they move the max to 30 then as well, would be your.
What was that?
So
Yeah.
max to 30 and target to 20 is Craig's suggestion. I just want to flesh that
Okay.
out.
Now, why don't we do that? One thing I would suggest would be international equity. Don't have a target in there. Just use Canada and US equity markets, 10 each. And then because getting into international equity markets is, unless you do it through an ETF or something like that, is extremely expensive to do.
What we do, Jeff, is we just separate it to Canadian equities and foreign equities.
That's a really great idea.
Yeah.
That allows you to
That covers everything.
And then we just define that it can be Canadian, US, or EFI equities, global. Everybody good with that?
Sure.
Well, except don't you want to have a maximum for EFI? Like then you can have 20% in EFI. Or not 20%, but it'll be whatever it is.
But if we combine EFI and US equity,
Yeah, I mean, if your target is 20, you might as well have 10 and 10. That gives you the leeway, and then make the targets like 20, or sorry, the maximum 20 for either one.
10 form.
I see, yeah.
Right? So you've got a target of 10 and 10 Canadian versus foreign, and then minimums of 0 and maximums of 20.
In each case, yeah.
Then you've got lots of room to get into trouble or add return.
We'll take the latter.
Yeah.
Okay, so we're in agree. Are we in agreement in switching that to foreign equity and just going 0, 10, and 20?
So
And Canadian 0, 10,
Well,
and 20.
now, quick
Could I
question
just-
would be the, sorry.
Can I just jump in here before we, I thought the whole point was incremental, or one of the points beyond capital preservation was incremental return. And there are ways to do that, dividend products, that kind of thing, that aren't, they are more risky than fixed income for sure. But that will likely trade directionally similar to fixed income markets. So, I mean, you've got to be cognizant of, at 20%, you're not adding a lot of incremental return. When the increment above the bond market, I don't know what risk premiums are, but it's, the TSX dividend, TSX 60 dividend index yields 3% now. So compared to what Thierry was saying at 1.3, 1.5 in the municipal market, you're not adding a lot. It'd be nice to assume some capital gains, but in this market, I'm not sure you want to do that. So even there at, you're not adding a lot of incremental return in the first place, and then to further limit the weight, and I'm not arguing against it. I just want to make sure that we're conscious of what we're doing when we cut that weight back. I mean, I understand the apprehension about the current markets, but what we had discussed previously was sort of easing into the market over the next year, maybe even year and a half, to get to what our targets were. But I completely understand that capital preservation is number one, and you guys don't look good if that doesn't happen.
And you also don't look good if you're not meeting your target on a consistent.
Well, no, and exactly. I understand. I understand all of that. But you just be cognizant of what we're giving up, because we're sort of laid into this cycle, and everybody's scrounging for yield.
Yeah. Perhaps what we should do is we should set it lower, and then when we start reviewing this document in a year's time or in 2 years' time, suggest that maybe if we're more comfortable and we've deployed all the money we want to into the growth side, and we want to do more, is maybe when we expand that out a little bit more.
Yeah, I think that's a great idea, Jeff, is that once we get to 20%, which will not be immediately,
No.
then we can review and see where we want to go from there. Yeah, that's a great solution.
Shall we do that? Everybody in favor?
Works for me.
Yes.
Yes.
Yeah, that's a great idea.
All good? Okay, so 0, 10, 20, 0, 10, 20. Canadian equity and foreign equity, and then a maximum of 30% overall for equity, total equity, and a target of 20 for overall equity. And then I guess we need to do something for the target mix for the fixed income to get that extra 10% back up again, which should we throw that into government of Canada bonds just to have that there, or is another place you want to put it?
Yeah, if you use the index weights, it's roughly 40% federal, 30% provincial, 30% corporate. So we could multiply that out and just use something similar to that.
Any thoughts on that? Everybody okay with that?
Yes.
Yeah.
So I'll take it back to, so if we collapsing and then just having Canadian and international or foreign equities. So
yeah.
Any idea about what benchmark we might use? Again, I just go back to those, if you, any idea?
I would say S&P 500. And then if you choose to go into EFI, you better add some value. Well, no, I'm just saying, like,
Okay.
I know later on you say that you're going to be using ETFs. So what Jeff said wasn't, as far as costs, maybe doesn't play, but still, I mean, it's a small enough weight that you don't want to get too fancy. But if you can add value, then you'll get credit for it.
Yeah, I agree with you, Gord. I think just make it simple: TSX, S&P 500, and again, this is something we can review later, but they're easy to get, and I would doubt you'd be going outside the scope of North America anytime soon, Terry, unless there's something screaming out there that you need to buy. But even if you do that, to Gord's point, if you pick up return on it versus the S&P and the TSX, more power to you.
Yeah, just to throw it out there, another one that's used is the MSCI World Index.
Yeah.
And that's got a big US weighting in it.
Yeah.
I don't know what the exact weights are. I'd have to look into that. But
Yeah.
But it has Canadian embedded as well, right?
yeah, it's really small though. Yeah.
It's 2%.
Canadian, so
It's
such a
2%,
small
okay.
It's about 60% US.
60? Okay.
Yeah.
Yeah.
And
And
they're one
emerging
of
markets
the,
too.
So are we going to use the MSCI World then for that? Just so we can,
I was just going to say, because that way you could overweight the US if you like it.
but,
You use the
okay.
S&P, you can't really overweight the US at all, right?
So they're anyway, they're one of the most expensive as well in terms of benchmark data.
Okay.
But again, we'll keep the Bloomberg alternative as well.
Can you get the S&P very easily though, Terry?
I think Jason sent for pricing. But anyway, the S&P is pretty. I mean, we can have access to that. I think it's like most of the Bloomberg indices as well. They track pretty close, yeah.
Yeah. Okay.
And
why don't we just keep it simple for now, rather than
Okay.
go chasing costs and having Craig starting to stay up at night with all the costs that you're in portfolios.
it's budget time, so.
Yeah. Oh dear. Okay. Are we good with the 4.1, and we can maybe move down to the asset classes, item 6?
Yep.
Okay. Under the equities, I just had one comment that I wrote in here. And I was wondering about liquidity and market float, or the capital that's available in the markets. There are no limits there. And, but I'm sure, I don't think council or any of us would want you sort of going into small cap equities or anything like that. Any thoughts in terms of putting some parameters around the market float that's available?
Yes.
Doesn't have to.
I put some in there.
Well, why don't we just leave that? Because Theory's not going to do anything too crazy here. So just a point to consider at some stage. Because those are
Jeff,
parts of the market that are liquid.
Yeah, and like 7.22 talks about using ETFs or index funds.
Yeah.
So that pretty much, you know,
That's what
10%
you're gonna be
Is
doing.
it?
Yeah, okay,
Yeah,
that's not.
pretty much
not
solves
hard.
your problem.
Yeah,
Okay.
you're right, Gordon.
We'll just keep an eye on him if he starts loading up on small cap Canadian ETFs or something.
Yeah.
I would have gotten that idea from Gordon.
No.
Okay. Are there any other things that you want to discuss in the equity portion of this, or can we move on to fixed income? Okay, Terry, we talked about fixed income prior to the meeting. And if you notice in the table on 4.1, they're talking about must be rated item 2 asterisk must be rated at a minimum investment grade by a major credit rating agency. And I've always, when I've done investment guidelines and investment procedures, have stated, you know, is it BBB or equivalent at another rating agency? Just so you have that defined line there, so that the investment grade is actually spelled out.
Yeah, I'd recommend using the index rating. They have a process where if there's 3 ratings, they use the middle one. If there's 4, they use they drop the top and bottom, and
Yeah.
you know, stuff
So
like
they take the median or the average.
Yeah, it's a defined process.
Yeah.
But again, I guess you don't have the data, right? So.
Do you have that data theory?
No, if I pull the information now, that's again cost, because Bloomberg, we are charged by the amount of data that we pull per month. So if I want to pull credit rating, usually I can pull for like the major 3, but each data pull is goes against a lot of data. So yeah, but I mean it makes sense if we pull the data from at least 3 sources, and then we take the median.
Yeah, the median, and if there's only 2 ratings, you use the higher one to be more conservative.
Okay.
So if there's like a double B high and a triple B low, you'd use the double B high as the rating.
So and the other thing is, so the only thing that would so use the hierarchy, right? Because sometimes you have it can be non-rated by one of those,
Yeah,
and then you have basically 2 rating and then an NR for the third one.
2 ratings, use the more conservative one, the lower rated one.
It's
Okay.
not often you get a split rating though, is it?
Well, once in a while you do. I mean, there's a lot of different ratings within the category. Like you'll have triple B high, triple B mid, which doesn't matter, but once in a while. So you had the auto companies like Ford and GM. They were split rated between high yield and triple B low.
Right. Right.
It's not overly frequent though, no.
Okay. So we're looking at a triple B as your minimum quality in the portfolio?
Or equivalent, so that we don't
Equivalent.
frustrate the people that what are they called again? Everyone uses a triple B, or except for what's the rating again? Uses a different naming convention.
Moody's.
Okay, Moody's. No, it's not. It's not Moody's.
DPRS?
No, is it Moody's?
Yeah, they like BAA or
The BAA. That's correct. Yes.
Yeah. And investment grade, is it not triple B plus?
No, triple B.
Triple B.
Triple B? Okay, thanks.
So on that, I would also recommend that we have a triple B limit in here, and also an average portfolio ratings comment to have an average single A for your whole bond portfolio.
Yep.
Yeah, I've seen that and done that before too, Mark. That's a good idea.
So the triple B index right now is about 12%.
12%.
So common would be to use 15 or 20% as the maximum triple B weight.
Give the maneuvering room. Yeah.
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 Yeah, I'd say 20% would be reasonable
I agree with that.
as a max. Yeah.
Yeah.
It will be max of 20% and an average of single A.
Okay.
You get all that, Thierry? You're good? So we're gonna embed that in this section, 6
Yeah, 6.1, yes. So I'll just kind of put brackets and then just specify.
Okay. All right, are we done with the fixed income and we can move on to the real assets? I would take it that item A there is, that's your Electra investment, is it not? The infrastructure?
Yes, that would that would probably
Which is
But
kind of outside of
I think we
scope.
can take this
it's
right
not.
out.
I wouldn't.
We could take it out.
Yeah, we can take it right out.
Okay.
Because we're not investing in real assets in
That's
this.
it.
Yeah.
And leave B in there just in case people are asking about it, or take that whole section right out. Is that?
I'll probably just leave the.
Well, it's defined in 611
Yes, it
units
is.
and real estate trusts and E.
Yeah. So you're
Yeah.
covered
So
there.
yeah, we can take it out.
Maybe take that whole section out just to simplify things a little bit and renumber.
Yeah.
So 6.13. I guess here we can specify prime as the credit quality as well.
Yes, I was just going to mention we need to put in a minimum credit quality in your cash and short terms.
Yeah, so those ones are different ratings, A1 and P1, I think it is. Is that what they use now?
Yes. So anyway, that's where you have a whole variety of rating scale.
Okay.
But I guess all the way. So I guess like R1 till R3 is supposed to be is considered prime. So and then you have like the mid scales, high, low, and mid.
Yeah. So anything with the one's considered investment grade, I think, right? And then when you get to the two, that's considered the triple Bs would be a 2, I guess, right?
Yes, but with a slight. So if you were to basically take a rating, there is actually a table that let me quickly see if I can. That kind of correlate between the long-term rating with the short-term rating.
Right.
So if you pick investment grade, so basically you're picking up all the from R1, which is named prime. So from R1 to R2, R3 is basically named prime, and then that correlates with investment grade. So Tara, is Tara still?
Hello, I'm here. I am here.
Okay, all right. So basically, it's fine. I can read it out. So prime 1 is considered basically from AAA all the way to A3, depending on the scale that you're reading. So prime 2 picks up from A3 all the way to double. Now this is a Moody scale. So AA2, and prime 3 is basically the bottom line. The bottom is triple B. So that's kind of what it looks like. Now, not prime is anything else that's below. So it's short term. We can leave it at prime 1 if you want. But if you
Is there a lot of pickup between prime 1 and prime 2?
those levels, I don't know what pickup is.
Okay. No pickup in yield?
It's really like, you have so much compression at those levels. I don't know if
Just to remain conservative, do you want us to stay with prime 1 for now?
Yeah, I'd recommend that, especially for
Yeah.
a portfolio, right? You want that for liquidity anyway, so.
Yeah, you're right about liquidity, yes.
Yeah.
So, okay. Anything else in cash and short-term deposits? We're good? Derivatives. Any thoughts?
I'm not sure why. Well, I know we need to have it in there, but I wouldn't expect we'd be using it.
I was going to ask the same question.
Well, you know what happens if you do get, if it's a good market and you do get a big cash inflow, it'd be nice to have the ability to use the derivatives.
Yes. And mostly, I would say, really, again, the philosophy is as a risk management tool,
yeah,
more than necessarily going out to try to pick, an additional yield. But I would say the philosophy is really as a risk management tool.
Right. Yeah.
And you're not allowed to use it for a net leverage position, so you're only going to be taking the position as much as you have cash to cover off the derivative underlying value as well.
Absolutely.
So that is not a risk.
You ever use them as a rate lock when you're doing a new issue, or? That I guess we think about it, but it is in terms of when we issue, so the idea is right now, for example, this in this current environment, why wouldn't you try to, if you think that there's a risk to the upside, like of rate increase, why wouldn't you forward fix some of those rates that we're seeing right now? But I would say yes, we have it as kind of in our current policy. I think we took it out, but it is there as a tool. Makes sense, but it is.
There is a restriction too under Municipal Act, right, Tyrion?
No, not with. So there used to be a restriction in terms of the time. I think it was like 6 months, but it's been that restriction has been taken down. I think it's been extended. Maybe Paul, if he still recalls his. Paul, you still recall some of? Have you you've dealt probably with a lot of municipalities using their forward rate agreements. Any insight in terms of how much municipalities would have used some of those agreements? You muted.
All right, there we go. Yeah, not widely used, to be honest. I think that the attitude often is you don't really get if you get it right, you might get a pat on the back. If you get it wrong, you have to answer a lot of questions in front of council, right?
Yeah, I get that.
So it's just not worth it.
Yeah.
Makes sense.
All right. So we go on to section 7, the implementation plan.
Mm-hmm.
Yep. That was a great discussion, by the way. I think we really covered a lot of ground and sorted out a lot of things on that, which is good. It's good ground. It's laying great groundwork for this management of the portfolio. All right, Derry, you want to run us through this? This is your
okay
plan.
Yeah. So this is assuming that everything above is good. So this is kind of how we see the next steps forward. So the next step is. So currently, this year we've pretty much been anything that's been maturing. We've been pretty much sitting in cash, so in the money market portfolio. So, and we're spending this event. So investment IPS approved, investment plan is approved. Now it's like how do we go about basically doing it? So the first thing we're gonna look at is kind of moving money. If you can imagine right now, the bulk of the money is in the money market fund, right? So which we said is like 15% allocation. So we're gonna the first step is to redeploy money into the fixed income portfolio. So once we get to that allocation, and that currently, it's just it's what we've been doing. It doesn't cost us anything extra. There's nothing extra to be dealt with, except that again we probably want to wait till the budget is passed, so we kind of get a sense of our cash flow forecast in the next 5 years. Then so that's step number one.
So expectation is to have the fixed income deployed by year end. Step number 2 is the growth fund. So which is where we said at this point, I don't think we are thinking about kind of stock picking or anything like that. So the idea is really to use ETFs to get the equity exposure. And again, it is going to really be gradual. So our expectation is really doing it in a fashion that's however time it would take us to get there, that within the reason, that's kind of how what we're not target. But we have a few things to deal with before we get there. So especially on the infrastructure side, so we still have to kind of sign up to get live data from Bloomberg, because we didn't have a need for it before. So we have to we're working with our custodian to link up our the custodian account with the Bloomberg account, so that overnight you have a feed between the two. And so things like that. And then also the benchmark data. So we still have to kind of price those out and set up the agreement so that we have access to them. So this is kind of the work to be done before we, from an infrastructure perspective. And so these are really the kind of the two main issues. So it is currently we're in the money market portfolio. What is the plan going forward? So in the month of December, or at least before year end, we're hoping to basically be able to reallocate funds to the fixed income portfolio. Now that would satisfy the fixed income allocation. Now the equity is really kind of a gradual. So the target date, who knows what the market looks like, but it is going again to be a really incremental, gradual, and then for us to get there. But we still kind of have to deal with the technology whereby it's getting live data and all that. So that's kind of what the plan is.
I would say that you should have a schedule or a drop dead date or something on the equities, because I mean it's always going to be never going to be the right time. It'll either be, oh, we should have went in last week, or oh, I just want to wait a little longer. So I think you need to set yourself a schedule or something, or a deadline, maybe a year from now or a year and a half, or you decide, but you and do it systematically so that you get to your goal. And you're doing maybe 2% every quarter or something like that, because otherwise it'll spend, first of all, you'll spend a lot of time thinking about it.
That's true, yeah.
It's not really productive time. I mean, you think it is, but it's not. Anyways, that's it.
And just back to that point about market timing, which Thierry brought up. I mean, that eliminates that. I mean, I don't like it to be mechanical all the time, but Gord is exactly right. Like if you're always waiting for the right time, and you're actually timing the market, and they say you should not do that.
That's true.
So
maybe even narrow it down to 1% a month or something like that.
Yeah, or have a range, 1 to 3% a month, depending on how you feel, but you have to do at least the minimum amount to get in. But Gord, that's a very good point, because a lot of people, when 2008 came along and they, were waiting to get in, and now the freight train left the station a long time ago at a high speed. It was too late. So.
Well, yeah, and these days, I mean, it's who knows.
Yeah.
Really.
Yeah, you just got to do it in a disciplined fashion. So.
Yeah. So if we say 1 to 3%, with a 2%, I guess, by the end of the year, or at least by 2022, we should have it allocated. So that makes sense.
I don't think we should put anything in the document here, but I think we need to discuss that amongst ourselves when we do meet, to see where you are. if we put it in the document, it becomes way too mechanical, and we might want to just hit the pause button on this thing if things aren't looking particularly great in any given month or something like that. So extreme valuations, so to speak. So okay, I think we need to approve this document. Is that correct, Tara? Okay. I would like to move that we approve the document with the amendments that Jason has been so carefully recording here and theory for approval to be sent to the next level for the government.
Finance and corporate services.
Finance and corporate.
So can we approve it, but have an opportunity to review the amendments in case there's something missed?
Yeah, so we'll edit it and we'll forward it around to make sure everyone's in agreement to the amendments to the changes that are being done before it goes.
Do we have to approve this, or do we have to wait for another meeting to do that? What should we do, Tara?
We did last time. We did the same process. We just I wrote in there about pending. I can't remember exactly what it was, but it's fine to do it right now.
I think it was called pending changes agreed upon.
Something, yeah.
If we can word it like that.
Yeah.
Pending review of the changes made today.
Yeah.
Okay. I guess we need a seconder for that.
We don't actually require seconders in these meetings, but if somebody could move it, or
well, I just did.
Yep. And
all those in
everybody.
favor, I guess. Show of hands.
Yep.
Okay, carried. Unanimous.
Perfect.
All right. Well, thank you. That was great work. That's a lot of work.
That was a lot of work. That was good discussion. I don't know if we want to talk about the next meeting or dates, or just come in early, or.
Are we going to quarterly?
Wide open. I'm not going anywhere.
Will the meetings be quarterly now, or are they?
I guess we should probably look at making them on a quarterly basis. I think what we need to do is, by sometime in the new year, see where theory has got in terms of deployment and review that. Does that sound reasonable?
I wanted to kind of mention that as well, but again, without. So anyway, a meeting is goes with the time, and then the compensation and everything. So, but for especially now that Tara, is this being recorded, or are we off the?
Yeah, no, we're not. We're still on.
Okay, all right.
Would you like me to adjourn the meeting?
Can you adjourn? Yes.
I will. Okay, and then I can.
Adjourning the meeting. Okay, thank you.
Okay, and I'm